You label Bitcoin as risky because you are focused on price volatility. You label money in a bank as safe because the number remains unchanged. I will show you why this mindset is already eroding your purchasing power, slowly, quietly, and without your consent. Every cycle, every market phase, and every headline brings the same question back into the conversation. Is Bitcoin risky? You ask this with genuine concern. You believe you are being cautious, responsible, and rational. But the question itself reveals a fundamental misunderstanding of where risk actually lives. You are defining risk as volatility. You are defining risk as short-term uncertainty in price. This is a mistake. Risk is not the movement of price. Risk is the probability of the permanent loss of purchasing power over time. Once you define risk correctly, the entire discussion changes. You must realize that waiting is not a neutral choice. Doing nothing is not a passive act. It is an active decision with specific, calculable consequences. When you hesitate, you believe you are avoiding danger. In reality, you are choosing the default path. And the default path is exposure to monetary debasement, counterparty dependence, and long-term erosion of value. This is not an opinion. This is a structural reality of the current financial system. Consider the alternative you are embracing by waiting. You are choosing to store your economic energy in a medium that is designed to lose value. Central banks expand the money supply to manage debt burdens. This expansion dilutes the purchasing power of every unit of currency you hold. This is a guaranteed loss. It is predictable. It is engineered. Yet because the loss happens slowly and the nominal value of your account remains stable, you perceive it as safe. You are mistaken. Stability in nominal terms is masking a certainty of loss in real terms. Bitcoin, by contrast, presents a fixed monetary policy. The supply is mathematically capped. It cannot be diluted by a board of directors or a political committee. The price of Bitcoin fluctuates because the market is discovering the value of a scarce asset in a world of unlimited liquidity. This volatility is the mechanism of price discovery, not an indication of structural flaw. The risk is not that Bitcoin moves. The risk is assuming that systems with unlimited supply expansion will somehow preserve your value indefinitely. That assumption is contradicted by all recorded economic history. If you measure risk honestly, you have to measure what happens if you wait. You are not standing still. You are moving backward relative to scarce assets. The longer you wait, the more capital you will require to acquire the same fraction of the total supply. The real risk is not acting. The real risk is the decision to remain exposed to a system that is mathematically guaranteed to depreciate. In the world of traditional finance, risk is frequently confused with movement. You observe an asset price fluctuating on a screen, and you label it risky. You observe a currency unit remaining static in a bank account, and you label it safe. This framing is convenient for the incumbent system, but it is analytically incorrect. You are conflating volatility with risk. Volatility is the rate at which the price changes. Risk is the probability that the value will be permanently destroyed. These are two distinct concepts. Stability in nominal terms often hides a certainty of loss in real terms. You must look at the data. Over the last 50 years, every major fiat currency has lost the vast majority of its purchasing power. This depreciation did not occur by accident. It did not happen suddenly. It happened gradually, predictably, and by specific design. The central banks have a mandate to target a positive rate of inflation. This means they have a mandate to devalue the currency you work to acquire. Consider the mechanics of a standard savings account. If the bank pays you 2% interest and the monetary supply expands at 7%, you are not generating a return. You are suffering a loss. You are losing 5% of your economic power every single year. This loss compounds. It is silent. It is invisible on the ledger, but it is a guaranteed mathematical outcome of the system you are trusting. A guaranteed loss is the definition of maximum risk, yet you perceive it as safety because the number in the account does not go down. Bitcoin offers the inverse proposition. It does not offer short-term price stability. It offers a fixed monetary policy. It offers a known supply cap that cannot be altered. It offers a system that does not rely on trust in issuers, trust in managers, or trust in political institutions. When you hold Bitcoin, you are not relying on a promise. You are relying on a protocol. The risk is not that Bitcoin moves. The risk is assuming that systems with unlimited supply expansion will somehow preserve value indefinitely. That assumption has failed repeatedly across history. It is failing now. To view Bitcoin as risky is to misunderstand the fundamental nature of money. The risk lies in the decision to store value in a medium that can be printed without cost and without limit. That is not safety. That is the certainty of decline. Doing nothing feels comfortable because it creates no conflict with your past behavior. You have been conditioned for decades to believe that holding cash, sovereign bonds, or traditional savings instruments is the definition of prudence. This conditioning is deep, but it is empirically false. You are confusing familiarity with safety. You are assuming that because a strategy of passive fiat holding worked in a previous era of lower debt and positive real yields, it will continue to work in the current structural environment. It will not. By choosing to wait, you are not opting out of the market. You are maintaining a 100% long position in fiat currency and sovereign debt. This is a position with infinite supply risk. You must analyze the structural incentives of the issuer. Monetary expansion is no longer a temporary emergency response to a specific crisis. It has become the baseline operating requirement for the global financial system. Global debt levels have reached a magnitude where they can only be serviced through the continuous debasement of the currency denominator. The incentives of the central banks and the treasury departments favor dilution, not restraint. They favor inflation, not deflation. When you wait, you are betting against these structural incentives. You are betting that the authorities will voluntarily choose austerity and explicit default over printing. History and logic suggest this is a probability of near zero. By waiting, you are not standing still. You are moving backward relative to every scarce asset in the world. This is a function of simple arithmetic. Bitcoin has a fixed supply cap that cannot be altered. The fiat currency you hold has an uncapped supply that is expanding. As the supply of currency expands to meet debt obligations, the nominal price of scarce assets adjusts upward. Every year you delay your decision, the amount of Bitcoin you can acquire with the same nominal capital decreases. You are increasing your cost of entry. You are voluntarily accepting a future where you own a smaller fraction of the total supply for the same amount of labor. The real risk is not acting too soon. The real risk is postponing adoption until necessity forces you to act. If you wait until the currency debasement accelerates to a point of undeniable crisis, you will be forcing yourself to enter the market under conditions of distress. You will face higher premiums, fewer options, and extreme competition for the remaining liquid supply. Waiting is a decision to trade a strategic entry point today for a desperate entry point tomorrow. You are ignoring the axioms of monetary inflation. You are hoping for a miracle where arithmetic is required. Bitcoin presents a unique asymmetry in the modern economic landscape. When you allocate capital to this network, the downside is mathematically limited to the amount you invest. You can never lose more than your initial cost basis. The upside, however, is participation in a monetary network with global reach, absolute scarcity, and increasing adoption curves. This is an unbounded potential return relative to a bounded risk. In traditional finance, such asymmetry is rare. In a monetary revolution, it is the defining characteristic of the winning standard. More importantly, Bitcoin removes specific categories of risk rather than introducing new ones. There is no issuer risk. There is no dilution risk. There is no requirement to trust management decisions, policy committees, or quarterly earnings reports. When you hold equity in a corporation, you are exposed to execution risk, competitive risk, and regulatory risk specific to that industry. When you hold sovereign debt, you are exposed to the fiscal solvency of the nation state and the political will of the treasury. When you hold Bitcoin, you are holding the protocol itself. You are not betting on a team, you are betting on the code. When held in self-custody, Bitcoin eliminates counterparty risk entirely. This is a fundamental deviation from the architecture of the legacy financial system. In the traditional banking model, your asset is someone else's liability. Your deposit is a loan to the bank. If the institution fails, your access to your capital is severed or dependent on government insurance schemes. Bitcoin operates without this dependency. The ledger is distributed. The verification is decentralized. Your ownership is established by cryptographic proof, not by the permission of an intermediary. This asymmetry extends to the global stage. For an individual, it is a savings technology. For a corporation, it is a treasury reserve asset that protects the balance sheet from inflation. For a nation-state, it is a tool for geopolitical neutrality. The same protocol serves all entities with equal indifference. It does not discriminate based on geography or jurisdiction. It functions as a closed system of value that cannot be manipulated from the outside. The risk is not in owning an asset that fluctuates. The risk is in not owning the only asset that no one can print, no one can debase, and no one can censor. That is the definition of financial sovereignty.